we're going to get a pretty chunky inflation number. My question to you is this as high as it goes? And as it starts to come down, where do we settle out at?
Yeah, well, both of those are important. It feels like this is about as high as it's going to be. As you know, in the US, when we report the inflation data, it's a trailing average of the last 12 months. So 11 of the 12 months, we already know. All that happens is we drop off 1 month from a year ago and add a new month as we come in. So all eyes really should be on what are those new months coming in and how high is inflation. When you've got a city in China of almost 30 million people that's in total lockdown, you got to think that the supply chain issues that we've been dealing with over the last 2 years are not going to resolve in the next month. And there's obviously still the war going on in Ukraine. So both of those are question marks. If it weren't for that, I feel like this would probably be around the peak, but we don't know from the others.
So how long can these issues last? The supply chain issues, the commodity issues coming off the war in Ukraine, and the commodity issues that were there before the war in Ukraine as well, in addition to the other issues you just laid out. Give us a kind of worst case scenario of how much longer we can actually expect perhaps this inflation that is persistent before it goes into reverse.
There is no worst case scenario if you think about it, because if you keep getting new variants of the virus and places around the world keep going into lockdown, it could go forever. Now, that said, it does feel like the capitalist system is pretty good at trying to figure out what, if you give the information and you give some certainty about where we're headed, they're pretty good at then trying to figure out how to get around the constraints. So hopefully by the summer, you will see relief. You've already seen some relief on the oil price side. The events in China have thrown us a little bit for a loop. Russia defaulting on its debt, it was expected, yet is still gonna have to be processed through the market. But you're seeing freight rates come down. You're seeing oil rate prices come down. You're seeing some relief on a bunch of the supply chain. And as we get out of the virus fear era for the U.S. economy, and people can go back to spending their money on services instead of on physical goods, that's the root of what went wrong in the U.S. The prices of physical goods soared through the roof because the supply chain cannot handle that level of demand. And if we go back to spending money on services, I think there's going to be some relief there.
Austan, I'm really glad you mentioned the China piece of the equation, because that's something that is perhaps even more persistent, changing that zero COVID policy, changing the mass testing program, and the port closures that have so affected those supply chains. I'm curious, though, what it's going to take or what the timeline looks like in terms of redrawing some of those global trade routes. We know the Biden administration, for example, has been very vocal about bringing some of that production that has been abroad, especially in Asia, onto U.S. soil. What does that do to the long-term view of the United States and perhaps the globalization that might come apart?
I know a lot of people have been talking in that way. I'm a little more skeptical that once we're out of the COVID era, that these changes that have been forced upon us in the supply chains are going to be permanent. I think when COVID is over, we're going to rediscover how we got to the lean supply chains before, which is it's cheaper and there's big economies of scale. But certainly in the short run, we have been spending a year and a half scrambling on the supply chain, trying to get out of single source supply. We've had some decent success. So if this had happened in Shanghai a year and a half ago, I think it would have been more devastating than it's going to be now, precisely because we've kind of diversified a bunch of the supply chains. Some of it's come back to the U.S., some has gone to Mexico, to Vietnam, Indonesia, different places. So we can diversify a little away from China, but it's the virus. It always seems like the swamp thing. It's done, it's past us, and then out of the swamp comes the hand to pull you back in. And it feels like in China, they got to get some real vaccines, and they got to get them quick.
Yep.
and get people vaccinated. Otherwise, they're going to be facing these kind of lockdowns, because these variants are massively more virulent and spread faster than the first iterations when they had the zero COVID policy.
Austin, what does this all mean for the United States? What does it all mean for the Fed? Let's talk about the economy. Larry Summers was on Meet the Press Sunday. He said, nothing is inevitable or certain in economics. Yeah, I think we can probably take that. But the Fed will have to be extraordinarily skillful and lucky to avoid a recession. How high would you put the odds of a recession next year, Austin?
I don't know what the exact number is. I don't think Larry's wrong to say that it's elevated risk. I mean, we've got wars, we've got respreads of COVID, we've got inflation, we got a bunch of things that are tough challenges. At the same time, the economy for last year grew at an epic pace and is a very strong labor market. And like I say, if we could get past the COVID era and go back to something like what existed before this COVID recession began, I think it would be fine. The Feds, you got to have some sympathy for them because this wasn't like any previous downturn. So there's no model. You can't just go look at the data from 1984 or from 1991 or from any previous period to get a good lesson of what the Fed should do, because this wasn't a recession that was driven by cyclically sensitive sectors. The demand for durable goods went up during the downturn. The demand for housing went up during the downturn. So the normal channels that monetary policy works through are irrelevant. Now we're all trying to figure out how fast are people going to go back to getting their hair cut and going to the dentist. And that's not something that the Fed has a big database.
Well, okay.
Experience to consult.
Let's talk a little bit about the labor market. The JOLTS number is massive right now. Clearly, there are lots of open positions. We're going to get into the earnings season next week for some of the industrials. You get some of them starting this week, obviously, with the banks, but I think you're going to get into the thick of it next week. We're going to hear from companies that they're struggling to employ people. You listen to the airline sector. They can't bring people back fast enough. They're having to cut capacity because they don't have enough people to bring online. As I say, the JOLTS number is enormous. What gets people back into the labor market right now? What fills some of those positions? Is it a higher inflation number? People have got to go back to work because they can't afford to get the groceries. Is it people's portfolios coming under pressure because the Fed's hitting the stock market? What gets the labor market back in balance, do you think, Austin?
It could be those, but I still think the most important thing is their fear of the virus goes down. Their schools are reopened and they can send their kids to daycare or to school. They're not taking care of a sick relative. They themselves are not nervous that they're going to get sick from a customer or beat up by somebody because they're trying to enforce a mask mandate and stuff like that. So I think as the health part of this gets better, the job matching part is also going to get better. Now, I would also point out that while business is saying we can't hire anyone and talking about the wage price spiral, the share of national income going to corporate profit is up, not down. So for whatever amount wages are up, it's not up as much as the corporate profits are up. So it doesn't really look, it looks like a very strong labor market, but it doesn't look as tight as what you would think from the language that people are using about how hard it is to find people. You'd think that they would be raising the real wage of workers, and they really have not been.
Austin, you mentioned the labor part of it. Let's talk about where else companies are actually going to be spending their money. Something in focus is going to be their profits. Are they going to be investing it in terms of capital expenditure? Does that help the U.S. economy's bottom line?
It would if they do that. I mean, so far you've continued to see high dividend payouts, share repurchases, things like that, which kind of points to their feeling that they don't have as many big investment opportunities. I was struck to see that Pulte, one of the big home builders, they're making money. The prices of housing is way up. You would have thought they would be investing in building more houses, but they're paying out a big dividend.
Right.
I kind of don't. I don't understand the full dynamic there. I do expect that with oil prices up as much as they have been, you're likely to see, if those prices remain high, you're likely to see a resurgence of capital investment in the energy sector. I think you will see resurgent capital investment in the housing sector because the prices are inviting it, and that will contribute to strength. There will still be pretty substantial fiscal drag as we roll off the American Rescue Plan going into 2022. So that's going to balance it out. So overall, I think the growth rate of the U.S. economy is going to be substantially down from what it was last year.